Ever feel like you're just drowning in financial information, especially, when you're trying to really graph complex market moves? Imagine having a tool that helps you cut through all that noise, maybe even reveal trends before everyone else jumps on board. Well, today we're doing a deep dive into exactly such a tool. The Exponential Moving Average, or EMA, it's one of the most widely used tools out there.
Absolutely. And our mission here is to sift through all the sources you've gathered on EMA and pull out the really crucial stuff. Think of this as like your fast track to getting up to speed on this key indicator. No fluff.
Exactly. So whether you're prepping for a trading day, maybe exploring new analysis techniques, or you're just, super curious, we want to give you those aha moments, those surprising little facts that actually make the stuff stick without the usual information overload. Okay, so let's unpack this EMA thing. What exactly is it? Well, at its core, it's a way to smooth out price data over time, like an average. But here's the key difference. It gives way more weight to the latest price action and that influence. It fades exponentially for older data. It's adaptive.
Right. And that's precisely why it was developed. It was meant to tackle that lag problem you get with the simple moving average, the SMA. Yeah. Traders needed something quicker, something that reflected recent price changes much faster. It was honestly a pretty big step forward in technical analysis.
Yeah, and what blew my mind, actually, when digging into the sources was its history. It's not purely a finance invention. I mean, the core idea, this exponential weighting, it goes way back, like 17th century numerical analysis with Poisson.
Wow, really? Poisson?
Yeah. And then much later, signal processing folks picked it up in the 1940s. In statistics, it was Robert Goodell Brown in '56, then Charles Holt expanded on it in '57. Brown gets credit for the formula we often see, but it seems like Ed Seykota, the trader, really brought it into the mainstream for, financial markets.
That's fascinating. So a concept bouncing between math, signal processing, statistics, and finally landing on trading desks.
Mm.
But the core goal, wherever it came from, is always the same. Smooth out prices, make trends clearer, filter out the day-to-day noise.
Mm-hmm.
And by focusing on recent data, it really acts like an adaptive filter. It's trying to show the market's current consensus value as it evolves.
Okay, so we get what it is. Now, what can you actually do with it? What are the applications? Well, first, big one, identifying trends. If the EMA line is sloping up smoothly, that suggests an uptrend. Sloping down, downtrend. Pretty straightforward.
Basic but crucial.
Then there's generating trade signals. This is probably what most people think of. You get signals when the price crosses over or under the EMA line, or when two different EMAs cross.
Right, the classic EMA crossover. A short-term EMA crossing above a long-term one, often seen as a buy signal, a bullish sign.
And it doesn't stop there. It can also act as dynamic support or resistance. So in a trend, you might see the price pull back to the EMA and find, buying or selling pressure right around that level, like a moving floor or ceiling.
Yeah, it bends with the trend. And it's also a building block, isn't it, for other indicators?
Absolutely. It's fundamental to some really popular ones. The big two are probably MACD, moving average convergence, divergence, and PPO, the percentage price oscillator. EMA is baked right into them.
We should definitely touch on that MACD connection later. It's important.
For sure. And finally, its versatility. You see EMA used everywhere. Stocks, Forex, commodities, even crypto.
And that widespread use, that flexibility across markets and timeframes it's why it's so popular. But, and this is important, that same flexibility means you can't just slap it on any chart and expect magic. Choosing the right settings, understanding the context of the market you're looking at, that's critical. It's definitely not one size fits all.
Such a good point. Misinterpreting it is easy if you don't adapt it. Okay, so to really get it, let's peek under the hood. Let's talk about the math, the engine room.
Right. So the core is this recursive formula. Now, don't worry, we won't get lost in the weeds with the math here. We can put the exact formula, EMA today, price today, EK, plus EMA yesterday, AQ1K, and the K calculation in the show notes.
Good idea.
But the key concept is this. Today's EMA value depends partly on today's price and partly on yesterday's EMA value. That EMA yesterday part is how it keeps that memory going. It's constantly folding in the new price while remembering the past.
Yeah, that memory aspect is fascinating because yesterday's EMA included the day before's and so on. It means all past prices technically have some influence, right? Even if it's tiny for really old data, it's still there. It's not like the SMA, which just chops off data outside its window. It forgets completely.
Exactly. The EMA has this exponentially fading memory, which kind of feels more intuitive, doesn't it? Markets sort of gradually forget. They don't just abruptly cut off the past.
Yeah.
Recent events just naturally have a bigger impact. And yeah, the formula looks a bit trickier than SMA, But the payoff is that faster reaction time, which traders really value, especially now that computers make the calculation instant.
So when we apply EMA, we're fundamentally assuming the market isn't just, bouncing around randomly with no direction. We're assuming its underlying average value changes somewhat smoothly over time, looking for those slower shifts. What did the source call it? Locally stationary.
Yeah, that's the technical term. Basically, the average isn't jumping drastically from one period to the next. And the unique assumption for EMA is simply that recent prices are more important predictors than older prices. That's the core belief.
Okay. So given that, where does EMA really shine? Which market conditions?
Well, it performs best in clear, trending markets.
Right.
Uptrends, downtrends. That's what it's designed to follow. And it's also great when you need those early signals. If you're trying to anticipate a shift in momentum or trend, its speed is a big plus compared to SMA.
But the flip side, where does it struggle?
Sideways markets, choppy ranging markets,
Yeah.
that's where its sensitivity bites you. You get tons of false signals, those whipsaws, where the price crosses back and forth over the EMA, but it's not really going anywhere. It can drive you crazy.
I've seen that plenty of times.
Yeah, and also in really volatile markets with big sudden spikes that aren't part of a real trend, those can make the EMA jerk around wildly and just obscure what's actually happening.
So choosing between EMA and SMA, it kind of reflects your philosophy, doesn't it?
Absolutely.
Mhm.
EMA users believe markets process info quickly, so recent prices are king. SMA users think all data in the period is equally valid for seeing the stable underlying trend. It's about how you think markets remember.
Interesting. Okay, let's shift gears to customizing it. What kind of data does it actually chew on? Most often, you'll see it calculated using the close price for each period, daily close, hourly close, whatever. The close is kind of seen as the market's final verdict for that period.
Right, the consensus price.
Yep.
But you can use other things, open, high, low, or even combinations like the median price or an average of the open, high, low, and close. You have options.
And what about time frames?
Any time frame, really.
Hmm.
From tick data, like millisecond level stuff, up to monthly charts, minutes, hours, days, weeks. It works across the board. The crucial thing, though, is clean data. It has to be a continuous time series. Because it's recursive, remember, today depends on yesterday, any gaps or errors in past data. They don't just disappear. They can actually get amplified in the EMA calculation, especially with shorter EMAs. Data quality is paramount.
Okay, that makes sense. Now, the big customization question. The length, or period, N, this seems like the main dial you can turn. So we have short-term EMAs, like what, 5, 10, 12, 20 periods are super sensitive, give early signals. Good for maybe day trading or scalping.
Exactly. Very responsive. But, as we said, much more prone to noise and false signals. Whipsaws galore if the market isn't moving decisively.
Then you have midterm, maybe like a 50-period EMA, sort of balance.
Yeah, the 50 is very common. It offers a decent blend of responsiveness and smoothness. Good for identifying medium-term trends, swing trading maybe.
And then the big ones, the long-term EMAs,
Yeah.
like 100 or the famous 200 period,
Yeah.
much slower, smoother.
Right. They filter out a lot of the short-term noise. They define the really long-term trends, more for position traders or long-term investors who aren't trying to catch every little wiggle.
So finding the best N, it's not like there's one magic number.
Definitely not. It completely depends on your strategy, the time frame you're trading, how volatile the asset is, what your goals are. It really comes down to testing it on past data backtesting and just experimenting to see what fits your approach. You're basically tuning the EMA's sensitivity to match the personality, the rhythm of the specific market you're trading.
Right, adapting the tool to the job. Are there other parameters besides N? I think I saw displace mentioned.
Yeah, there are a few others you might see. The smoothing factor K is technically there, but it's calculated from N, so the software usually handles that automatically. Displace lets you shift the EMA line horizontally on the chart, forward or backward in time. Some strategies use that. And of course, choosing the source price, close, open, high, low, etc. that we talked about earlier.
Okay. And it's interesting, even though the formula is pure math, choosing those parameters, especially N, seems quite subjective based on experience.
Absolutely. It's this blend of objective calculation and subjective application.
Oh, yeah.
Your experience, your eye for how the market is behaving, even just your feel for it. That all plays a huge role in selecting and interpreting the EMA. It really highlights that human judgment is still critical, even with these quantitative tools.
Let's talk performance then. How effective is EMA really? What are its strengths and weaknesses in practice?
Okay, strength 1. Reduced latency. It definitely lags less than an SMA of the same length. It reacts
Yeah.
faster.
Mm-hmm. That's its main selling point.
Strength 2,
Mhm.
higher sensitivity. It picks up on recent price changes more quickly.
Yeah.
Weakness 1, false signals. That sensitivity means it gets faked out more often, especially in choppy markets.
The double-edged sword we keep mentioning. Yep.
Signal accuracy. This one seems tricky. The sources mentioned back testing, maybe getting like a 65% win rate for a specific crossover strategy,
Hmm.
but that sounds super context dependent. Extremely context dependent. Those numbers mean very little in isolation. Back testing helps, but real-world results depend on costs, slippage, changing markets.
Yeah.
You can't just rely on a historical win rate. Past performance is not a guarantee.
Right, gotta take this with a huge grain of salt. And finally, smoothness. It smooths prices, obviously, but it's generally less smooth than an SMA of the same period, right? Because it hugs recent prices more closely.
Exactly. Less smooth, more reactive. That's the trade-off. You have to decide what you value more, speed or stability. And it depends heavily on the market conditions. Trending. Speed might be good. Ranging. Maybe you want the smoother SMA or just stand aside.
So, given these trade-offs, how does EMA compare head-to-head with other moving averages or indicators?
Okay, let's break it down. First, EMA versus SMA. We've kind of beaten this one up, but
Mhm.
EMA is faster, less lag, earlier signals. SMA is smoother, potentially fewer false signals and chop, maybe better for long-term psychological levels like the 200-day SMA. But they're complementary, really. Not necessarily better or worse, just different tools for different jobs or different market views.
Okay. What about EMA versus WMA? Weighted moving average.
Right. Both give more weight to recent data, unlike SMA. The difference is how. WMA usually uses a linear weighting today, gets the most, yesterday a bit less, the day before a bit less, in a straight line down. EMA uses that exponential decay we talked about. In practice, EMA is generally seen as slightly more sensitive, maybe a bit faster than WMA, but honestly, EMA is way more popular, way more common on platforms.
Gotcha. Now, the big one. EMA versus MACD. You mentioned earlier EMA is built from EMA.
Yeah, this is super interesting. MACD isn't really an alternative. It's like an evolution using EMA. The main MACD line, it's just the difference between two EMAs, usually the 12 period and the 26 period EMA.
Okay.
And the MACD signal line, that's a third EMA, typically a 9-period EMA of the MACD line itself.
Whoa, so it's EMAs all the way down?
Pretty much. So while a simple EMA helps identify the trend direction, MACD is designed specifically as a momentum indicator. It's looking at the relationship between those two EMAs to gauge the trend's strength, direction, and importantly, changes in momentum. You could think of MACD as EMA plus momentum analysis.
That makes sense. So you might use them together, like use a long-term EMA to see the main trend, and then make D to find entry-exit points based on momentum shifts within that trend.
Exactly. That's a very common and powerful approach. Use the 200-day EMA, perhaps, to say, I'm only looking for buys above this line, and then use MACD crossovers or divergences below the price chart to time those buys. It's an ecosystem.
Cool. Okay, let's bring this down to earth with some real-world examples. Where do we see EMA in action? Stocks, obviously. That 200-day EMA is huge for long-term trends, and everyone talks about the golden cross, 50-day EMA crossing above the 200-day, bullish.
And the opposite, the death cross, 50-day below the 200-day. Bearish signal. You see these cited all the time for major indices like the S&P 500 or big stocks, Apple, Tesla, you name it.
What about Forex? It moves so fast.
Oh yeah, EMA is massive in Forex because it's faster. You might see traders using, say, a 9-period and a 21-period EMA on an hourly chart for swing trades.
Yeah.
And again, that 200-period EMA often acts as a long-term filter. Only trade long if price is above it, short if below.
Commodities, similar idea.
Yep, very similar. You might use maybe a 14-day EMA on crude oil futures, for example. The principles translate well.
In crypto, with all that volatility.
Definitely used there too. Given the wild swings, combining maybe a 50-period and a 200-period EMA is common to try and identify the major trends and potential turning points amidst the chaos.
And didn't we mention earlier it even popped up outside finance? Like inventory forecasting?
Yeah, Robert Goodall Brown's original work back in the 50s, applying that exponential smoothing idea to predict demand for inventory, shows the versatility of the underlying math.
But all these examples just reinforce your earlier point, right? You have to tailor it. There's no single magic EMA setting that works for stocks and Forex and crypto and oil.
Exactly. Customization is absolutely key. What works beautifully in one market or time frame might be useless in another.
Okay, let's talk brass tacks. What about actual P&L? Do these strategies make money? The sources seemed a bit vague on large-scale proof.
Yeah, finding definitive, large-scale academic studies proving pure EMA strategies are consistently profitable is really hard. Like we said, you might see backtest results mention that 65% win rate, or a certain Sharp A ratio for a moving average system. But you have to be skeptical. Backtests don't include real-world frictions like trading costs, slippage, and markets change. What worked last year might not work next year.
So no silver bullet.
Definitely not. And crucially, almost every successful example or case study you read about, it combines EMA with something else. Other indicators like RSI or MACD looking at multiple time frames simultaneously, maybe volume analysis, and always strict risk management rules. EMA is almost never the whole story. It's a piece of the puzzle, a tool in the kit, not a standalone decision maker.
That's a really important takeaway. Oh, and one last thing from the source is this idea of self-fulfilling prophecy, especially for those really common EMAs like the 50-day or 200-day.
It's a fascinating psychological aspect. If enough traders are all watching the same 200-day EMA expecting the price to bounce off it, well, their collective buy or sell orders placed right around that level can actually cause the price to react there, reinforcing the idea that the EMA is significant. Market psychology at work.
Wild. Okay, so wrapping this all up, EMA, clearly a powerful, very flexible tool. Its big pros are speed, less lag, good for dynamic trends, and it's foundational for other indicators.
But the main drawback is that sensitivity. It can get noisy, give false signals, especially when markets are just drifting sideways. And choosing that period length N is super important, and it's more art than science sometimes, needing constant adaptation.
So the key takeaway for you, our listener, use EMA strategically. Don't rely on it alone. Combine it, maybe multiple EMAs, definitely other indicators like MACD or RSI. Always look at different time frames to confirm signals. Build a system. Don't just use one tool in isolation.
Right. And maybe a final thought to leave you with, stepping back from the charts for a second. Think about how many things in daily life, how many systems, or even just how we make decisions, rely on a kind of decaying memory of past events, just like EMA gives more weight to recent experiences. What does that tell us about decision-making, not just in markets, but everywhere?